Hello, thank you for joining us. Want to give you kind of an update and tell you what's been going on around here besides the obvious. If you've looked at your portfolios lately, you know that we've purchased quite a few positions since March 23rd. We actually started the afternoon of March 23rd, which turns out to be the low in the market. Of course, we didn't know it was the low at the time, but we did know we were able to buy some really good companies at really attractive prices. But besides that, what's been going on, we're talking to you right now from what's our new research room. You can see that there's Brian's station right here, and we've got another new person over here on the right, that, and then we still have another place for probably a part-timer, like a college student or something over here on the right that you can't see. But anyway, this used to be our conference room. So when you walk in the front door, you'll look through the glass instead of seeing conference table and chairs. This is our research room, and we expanded the office space, remodeled, had the furniture made, some of which you're seeing behind us. And but we've expanded, have a larger conference room and new offices down the hall, and are adding a few new advisors. We've already found one that is coming on with us, and we're talking to several more. So should have a pretty full house. Talk about what's been going on. Did you want to start, Professor?
Okay, thank you. Yeah, this is as far as an economic background and financial background. You're probably all very familiar with what transpired. Basically, 4 months ago, we were in the middle of a great economic expansion, probably the greatest in the last 50 years. The unemployment rate was definitely the lowest in the last 50 years, so we were doing quite well. The economy was hitting on all cylinders. And then the virus hit, as you well know, and someone blew the whistle, so to speak, and they told the buyers, the demanders to go home, and they told the producers to go home. So basically out of that comes economic numbers that are now being reported, which are quite low. And of course, the newscasters are trying to compare this to a great recession. Well, the numbers are low. The results are similar to a recession, but the causes were totally different. And so the causes being different, the repair was quite different. Basically, recessions, let me just remind you, recessions, and the last two large ones we had were the housing recession about 10 years ago and the tech recession exactly 20 years ago this spring. Basically, these are consumer durables that are overbuilt and oversupplied, and they finally get to the point where there's satiation in the consumer market for them. And basically you have a lot of producers with a lot of inventory, and there's no incentive to produce for a long time. And on top of that, you end up having balance sheet effects because there's a lot of debt both on the part of consumers and producers, which rolls to the banking system. So out of that, typically recovery of a recession is an 18-month event. This time we didn't have that kind of situation. And as a matter of fact, as soon as the whistle blew and everyone went home, they threw out fiscal and monetary policy in epic proportion and epic numbers in proportion to what we've ever seen before. Now, typically in an economic recovery, you have to repair balance sheets. Basically, you have to get rid of the excess inventory, which is a drag on the balance sheet because the debt exists, but the value of the assets are falling. So net worths are falling, both on the part of consumer and producers. And then the banks are hit as well. So just by having expansionary fiscal and monetary policy, it doesn't automatically turn around. This time it's a lot quicker to instantaneous because basically the banks were made whole immediately. The consumers were made whole immediately. The producers had this new program, epic program called PPP, it's the Payroll Protection Plan. Take this money from us and don't worry if you don't pay it back. Unbelievable. Never seen anything like that before. So basically we had a response. The Dallas Fed reports for Texas for the month of April just came out. Basically services are about 30% recovered, which require face-to-face. So they're nowhere near as recovered as retail sales, which are about 70% recovered. So basically, the throwing the money out is already having a response. We anticipate the recovery will be very quickly, and so is the stock market believing that. Now, when you have a pandemic like this, you also have a new paradigm of doing business, which generates new businesses, new concepts. As a matter of fact, we're speaking to you on Zoom, what was it, from 10 to
10 million users Zoom had at the beginning of the year. To a month ago, they reported 250 million users, and certainly it's gone up since then. Probably went up just this afternoon some.
Exactly. Since you all got on. Anyway, the long story short, we have a new paradigm, and it's affecting a lot of industries, which give rise to new companies and new companies that are very quickly getting listed on the stock market. So we have a lot of growth coming out of the pandemic of areas that didn't even exist 90 days ago. So basically, it is becoming now the economic event rolled over to the financial markets. So you have an event like that, the uncertainty is staggering. And basically, we only had, what, a 35% sell-off?
Yes.
Something like that.
And just in a few weeks' time.
In a few weeks' time, I'm rather shocked. Now, recessions are 55% sell-offs. I'm surprised it was that little, and only lasted about 2 to 3 weeks and then turned around, and we're essentially back to where we started. Now, not quite, but real close. And a lot of this recovery was I believe, the top 6 stocks that had something to do with communications, and you know the names. But what's interesting to me is, and they dominate the index, what it was interesting to me when I look at the charts of a lot of other companies, it had been, for example, airlines up until today. They've been saucering out with the C bottom and coming back up slowly. And then suddenly the numbers came out that they're making progress. And what did airlines do today? Like phenomenal, 30%.
American Airlines was up about 40% today, and the others were up around 15 to 20. So had a good day. Yeah, a lot of that was shorts getting squeezed. A lot of people had shorted the airlines, and when American announced this morning that they were adding new routes because of demand, well, that got it going, and of course they were very heavily shorted, and that's why they were the biggest benefactor.
Right. So that basically it's spreading out. It's not just the Zooms that are now. We're going back to the old standard American industry that couldn't operate when there was face-to-face contact, close contact. So basically, the recovery is happening. Yeah,
it's just even on the airlines. TSA reported that there were over 268,000 passengers last Saturday, which is 3 times the number on Saturday, April 11th. And it's something like 39% higher than 2 weeks ago. So people are starting to get out. The bookings are increasing a lot. Even the cruise lines are reporting very strong bookings for August 1. As a matter of fact, stronger bookings than they had last year. So it's kind of surprising, but that's where they are. People are itching to get out of the house.
Yeah. One last thing regarding economic recovery. We also have an environment that is very conducive to economic recovery. First of all, we have the lowest interest rates ever in U.S. history, ever. The long-term treasury is about 0.6 or something to that effect.
10-year, it's
very
close.
Which is very supportive not only of borrowing and spending, which is the usual way we look at interest rates, but it also is highly supportive of asset values across the board. Because as things stand, if you're running a pension fund or any kind of large institutional fund, and you're typically heavily invested in treasuries for the yield, the stability of the yield, well, the yield is so low that you'll go broke. You won't make your obligations. So basically, the institutional investors will spread from bonds to stocks and other things, in fact, that we're looking at strongly that have far higher yields.
Well, I think they're going to more and more gravitate towards real estate, preferred shares, such. That brings up something to talk about why those are such opportunities today, because when this hit, they held up pretty well in the beginning, and then what happened is that the fixed income mutual funds, especially, they got hit with a lot of redemptions. So now they typically, a typical one, they're all somewhat different in their percentages, but very many of them will have about 70% in bonds. They'll have maybe another 20% in real estate, and have about 10% preferred shares, or those last two numbers can be flipped. But what happened is the liquidity completely dried up almost overnight in the bond market. There were no buyers. And so as the mutual funds were met with redemptions, shareholders saying, hey, I want my money back, they had to sell. They couldn't sell the bonds. Normally, out of every dollar they need, they would get about 70 cents of that dollar from the sale of bonds, and they get the other 30 cents from the real estate and the preferred shares. But what happened to bonds, they couldn't find bids. They all of a sudden they were getting a nickel or a dime out of every dollar from the bonds, and they were having to get the other 90, 95 cents from just 30% of their portfolio. That was happening to lots of them all at once. It was happening to pretty much all of them all at once. And so they started putting in market orders because they've got to settle at the end of the day, end of the business day. And they put in market orders, and we saw some of these things drop, things that normally hold up extremely well in bad times, the real estate and preferred shares. Normally, you're only going to see them get hit if it's due to extremely high interest rates or rising interest rates that are rising quickly. Not from something like this, but it did because liquidity dried up and the funds started selling them at market, and also we're seeing them drop 20%, 15%, 20% in an hour. It was towards the end of the day a lot of times. That's led us to a great opportunity today because there's a lot of good real estate out there. You start searching through the rubble because they all got hit. A lot of these are sold in ETFs. So you have an exchange traded fund, you've got a basket of real estate REITs, or you have a basket of preferred shares, and a lot of people buy the baskets. But when you sell those baskets, you sell the good ones with the bad ones instead of being discriminate about it. So that caused the whole group of them, the good ones also, to their prices to plummet. And now it's just a matter, we've been going through that rubble and chipping away, buying here a little bit, and in many really good ones. Found actually a really nice one that we liked just today that we'll be adding tomorrow. And we're doing this, what we started doing on March 23rd is, we looked at, that was Monday, and the previous Friday, the market had one of the worst days, maybe the worst percentage day since 1931. It was also an extremely high volume. It was the highest volume I've seen. I don't know, I can't remember volume that high. And then, of course, over the weekend, people are worried about what happened on Friday. And so Monday was almost a repeat as bad as Friday. And by lunchtime, we had surpassed the volume for the first half day that we did even on the previous Friday. Didn't beat the volume by the end of the day on a full day basis. And what we did see is that towards, we were actually having our investment meeting and looking at that and how much the market was down in the morning, and talked about that we really believed that that was capitulation day, that was everyone had thrown in the towel that was going to throw in the towel. Anyone not throwing in the towel then was in it for a longer term or the long term. And, the sellers had pretty much between Friday and Monday, we believe, were done. I mean, they were gone. And we didn't know if that was right or wrong. That was just our speculation. Towards the end of the day, the market recovered a little bit, still a big down day. And we decided that we don't know if that is, we may be right or wrong about that being the bottom, but that didn't really matter because what we did know is that there were some really good companies selling at really attractive prices, and it didn't make sense not to start taking our cash and buying into them. What we did differently, and not a lot differently, but more dramatically, was each day we were probably buying 3 to 5 different companies starting the next day. We bought just one that afternoon. And then but the next morning we started buying 3 to 5 per day. But what we were doing is buying about 1/3 of the position. So what I mean by that is if your type of account calls for 100 shares of XYZ company, well, we'd go in and buy 30 to 35 shares right then, knowing that, hey, if we were wrong about that being the bottom and everything dipped a little more, well, we could go back in and buy the next third, and then we actually could buy the following third. And we knew that all of them we were getting good buys. We figured that 3, 6, 12 months from now, those would look like very attractive buys. And it's a way that we could make back any losses that happened so quickly mostly in March and then in April. So, or mostly in March, actually, take that back. But anyway, we've been doing that to the point where, depending on the type of account, we're either fully invested or we're close to fully invested, or you might have in a more conservative account, there might be in a typical one, there's exceptions to them, and usually those are personal exceptions. But typically, the more conservative accounts might have 10% or 15% cash, somewhere in that range. Of course, it's been a really good month or so. I will have to bring up, if you have the non-traded REIT, the Phillips Edison non-traded REIT, that one did reprice. Of course, they were unfortunate and had to do their repricing right in the worst time, they got appraised in May, and that was based on April rents and the previous rents, but the most recent rents are weighted heavier. So we saw that price drop from $11 down to, I think, $8.85. It was 21% drop. Of course, we bought our shares at $9.30 because since we passed the commission back to you, you got it at $9.30 instead of at $10. I definitely believe that will be back to $11 on their next appraisal. They're doing pretty well on their June rents have gone much better than their May 1st and April 1st rents. And they're expecting by next month that they will be not completely back, but they're talking in the 93, 94% range of rents collected. So they're on the road back, but they have the grocers, and they don't have to worry about the grocers, but they did have to, but all those little smaller regional and local stores that make up the rest of the shopping center, well, a lot of those had to close. They had no choice. So I just wanted to address that. But by the way, Phillips Edison they already have a ticker symbol. They expect to IPO. Until COVID came along, it probably would have happened very soon here. Now they're going to, of course, wait to get a good price on their shares and wait for this to kind of pass and get back to somewhat normal again. Let's see.
Would you say a word about the yields out there available?
Yeah, because of these drops, another thing we're looking at, and when we're deciding, of course, we're looking at the type of real estate. So there's some real estate that, of course, we don't want to have anything to do with. But even office space, I believe that there'll probably be 20% less office space on average needed across country because people have learned that a lot of people can work from home. I think that it won't go really beyond that. I think that would be reasonable, but the fact that that people like to congregate, and I think they're actually most businesses run more effectively and more efficiently if the people are housed and can communicate with each other easier than over the phone or through Zoom, what have you. We've seen, by most numbers, it looks like, and talking to most CEOs, it appears that the business bottomed in April to very early May. As Professor mentioned, well, we've got a lot of things backing us. There's and a lot of things that make us confident that the market can hold up here, will not retest the bottom. If it does, then some changes will, of course, will change with it. But right now, it's there's still $4.7 trillion in money markets. That's all money that's sitting on the sidelines that can come right back into the market. We believe a lot of money is going to come out of the bond market and into the stock market, giving further support. Fed's already said they'll do everything. Going back to the REITs again, well, what changed everything for the REITs and the preferred shares is that the Fed came out and said they recognized that this lack of liquidity was severe, and they said, well, they'll back the market now. They'll provide the liquidity. So that means that we should not have or will not have a repeat of the big fixed income funds not being able to get out of their positions. So the Fed will come in and buy those bonds, at least on a short-term basis. Congress is throwing money left and right at this thing, $3 trillion already, talking about another $3 trillion. Not sure that we need another $3 trillion. First of all, the Fed's only used a portion of theirs, and Congress only used about 1/3 of the original $3 trillion. The rest still coming out. So
they've learned a new trick.
Yeah, it's I don't know if printing money out of thin air is a new trick or not, but
no, the orders of magnitude.
Yeah, orders of magnitude. Yeah, they've gone from high billions to trillions. So
yeah, that's exactly.
Some of the green shoots we're seeing too is not only things like the number of air flights is increasing pretty dramatically on a regular basis. Semiconductor sales for April. We don't have May's numbers yet. Have them shortly, but April numbers were up 6.1% over April of 2019, and that was back when we had a good economy. Of course, those are the kinds of things that we first started looking at as investment, as companies that have that they work well, even something like this technology here, which we believe got a lot of bump from COVID as people were working at home. But when you see how many users, when you talk about going from 10 million to 250 million to probably 300 million now, that's a lot of users around the globe. And it's growing, and I think that this will be more and more a part of life. It's something that even my mother, who lives out of state, can see her grandchildren and me and my wife, but especially the grandchildren. And probably a lot of you have used it already to see yours.
Think of the universities that are going online.
Yes. Yeah.
Huge changes.
That's right. This was the number one for universities also. As a matter of fact, my older son, who's getting his MBA from Rice right now, is he did his last few months online. Wasn't happy about it, but he's looking forward to getting back in class. But still, this is something that's used all over. People were having virtual happy hours with their friends. all sorts of things. And then, of course, meetings and talking to you. Let's see. Other tabs. What else can we share?
Well, pandemics create new paradigms. For example, in real estate, there's a big movement out of downtown residents to out in the country or somewhere further away from the center of the city. It's already showing up here in Texas and Horseshoe Bay and the outlying areas of Austin already.
Yeah, and with more people working from home, it's put a new emphasis on cloud security and such. So there's a lot of companies that offer end-to-end security. Some of those are very attractive. Of course, you're going to have, before we know it, we'll have 5G. That's going to change things in ways much more than just your phone. People think of the phone, but there's so many other more useful or going to be used more things that we'll do in our day-to-day life. We'll have autonomous vehicles that I think there'll be a push to the suburbs. A lot of people between two things. We've had the pandemic. Now we have the looting and rioting that has gone kind of hand in hand. It's too bad, but with the protests, peaceful protests, attracting some people that just want to loot and steal. But between those two things, there's kind of a big movement from people in downtowns to want to, move further from downtown or even out in the suburbs, so that if there's another pandemic or future riots, what have you, they're not living in the middle of them. So we think that opens up other opportunities.
Time of change is a time of opportunity.
Yes.
And we have huge amount of that.
So just like in other bad markets that have been caused by whatever, whether it's the 2008 recession or the dot-com bust, or even just the last fourth quarter of 2018 when we had the Fed chairman have a terrible interview in early October and kept doubling down on that bad message until finally they changed it. But that pretty much wrecked the market there for 3 months. But we expect, just like those other times, we're going to come out of this one. You look back at it and say, well, hey, we're hitting new highs and it'll be back faster than people believe, because each time there's questions. And that there was also another one in 2011. There's been a lot of these big severe drops, 20% to 35, or like the Great Recession, 55% back in 08, 09. So each time the market came back, we came back, and we think that's we're going to come back as faster than the market, even in our more conservative accounts. We believe that being almost fully invested right now is a great thing. It's paying off, and we expect it will continue to.
Now, if you have any questions, is there a place they can, at the bottom of the screen, apparently there's a place to send us questions?
What do I do there? Okay. Might have to get our computer person in here because I don't see the.
Well, I think we'll be able to retrieve the next post.
Okay, I do. I'm having a hard time seeing all the questions, but I do see one where someone's asking, is the market overvalued? And that's certainly something that you hear talked about on the media and on CNBC or any other station you pull up that's talking about the stock market. But to give you an idea on that, we're looking at, first of all, the way you value a company. I don't care if you're looking at buying a local business. a good way to value it is to look at what you consider what are the future earnings, and you discount them by typically the 10-year treasury. And if we do that with the entire S&P 500, and of course, right now earnings, it's hard to say what earnings will be. You know, no one's giving guidance anymore, or very few are giving guidance. And how can that? You know, this is new. It happened so quick that you know, we shut down our entire economy for good, or whether that was smart or not, it happened. But the way you do it is you divide basically those future earnings by the 10-year treasury. Well, the 10-year treasury right now is around 70 basis points, so 0.7%. The earnings will probably come in somewhere around 70 to 80% is what we're seeing, because a lot of companies are increasing their earnings through all of this. Some of their earnings have dropped off for a quarter. You know, they closed. They had next to no earnings, although they weren't closed maybe for the entire quarter, but they're still partially closed, but we are reopening. So if you do that, let's assume, just to err on the side of being very conservative, if by the end of the year, the 10-year treasury jumped all the way to 1.2% from 70 basis points, which I don't think there's any possibility that that's going to happen. ECB just lowered everything over there today, so that puts more pressure on our rates to be pushed down. If by nothing else, European investors coming over here, buying a stronger dollar and a higher interest rate, and kind of benefiting from a little bit from the interest rate and a lot from the dollar, but not investing in negative rates. So, but if we use 1.2% and instead of 0.7%, and we say that earnings drop in half, that would give us a fair value of the S&P 500 at 3,100. So about 100, and I didn't see exactly what the S&P, I was trying to find it up there, but but it's somewhere around 3,000. So about 100 points higher, and that's if both those two things happen. So we believe that right now the market is not overvalued, but more importantly is that we're not buying the market, we're not buying the index. There is a lot of really good companies in there, because there's some bad companies. Man, the S&P 500 right now probably has 20% of the companies that may not even be, they may not be in business, or they at least probably won't be part of the S&P 500. They'll shrink enough and be replaced by another company that in the next few years, 20% of them at least will have changed. They won't be in it anymore. So just obviously avoiding that 20%, there's probably at least another 20% that aren't a whole lot better. But there are, at the other end of the spectrum, there are some really good companies that their prices haven't recovered yet either. They may have recovered quite a bit, but if you drop 35, 40% in price, if you drop 40% price from $100 to $60, well, now you've got to go up 65%. So even if you've already gone up 35%, 40% even from your bottom, you still got a long ways to go to get back to just where we were in February. And some of these companies, they're really not long-term impacted by this pandemic. So there's a lot of opportunity out there, and we'll continue to look for it. I think we'll continue to find it. Now, one more about, do you expect high inflation due to all the stimulus money being created? And you want to take that?
High inflation? Well,
let's
hope it happens. Let's hope it happens. Yeah. Basically, that means the spending is caught up with production, and basically people are being called back to work, and we're having income increases. So if that happens, basically it can be controlled, because the Fed is a two-way machine. They can eliminate money as quickly as they produced it, and they simply do that by selling the trillions of dollars of treasury bonds they bought and soaked the money back up. So basically, the Fed stays in control of it.
Yeah, and I don't think that that's even likely at all. We'll be lucky to find some inflation in the next few months. Certainly, especially after today, just one more thing hammering down inflation was the ECB action. Europe reducing their interest rates, like I just said, it's going to certainly, just like it has in the past, it's going to attract more money into our treasuries, boosting the value of the dollar and lowering our interest rates. So I don't see that happening anymore. If we do see some time out, of course, keep in mind that a little inflation is actually good for the stock market. It inflates the prices of stocks, commodities, gold, so there's and real estate. So if we're buying good real estate and we have good companies in our portfolio, both of those benefit. And if we really see inflation coming on, we'll add to our small gold position and even pick up some gold miners.
If you're not in bonds, it's a benefit.
That's right. The one thing you can't be in an inflationary environment is bonds, and I don't know why even in this environment we would want to look at being in bonds, because we've got no yield. I mean, there's companies are actually, Home Depot just issued, I forget how many billions of dollars that they did, but only the reason why they didn't really need money. They sold everything they could sell during this COVID environment, because many people stuck at home started looking around saying, geez, I could paint that wall, or I could paint this, or I could do this repair or that. And so Home Depot did a heck of a business during all this. They don't need the money, but when they get 70% return on invested capital and they can borrow at 1 3/4%, why not borrow and invest? So I think that's where many companies are. But when you're borrowing at 1 to 2%, that's it's not a lot of incentive for people on the other side. I mean, I'm not sure how they're selling all that unless a lot of foreigners are jumping in there, and then some pensions that have to own a certain amount.
Now, all in all, the most important perspective is when you're with Beck Capital, you have an active manager, and the active manager can move from one opportunity to the next and out of the way of trouble, as opposed to being indexes. I presume this is going to be a very, very high return market environment. It's probably been so for what, now 6 weeks? And
yes,
it will continue to be. Because things are not all recovering. First of all, they're not all recovering. Secondly, that some of them are recovering at breakneck speed, and indexes do not catch that at all. You get a bit of everything in an index.
As painful as the down market is, always the up market and the opportunity that follows. I think you'll find that it'll make up for everything and get back to all-time. We'll be back at all-time highs again, hopefully very sooner than later, but I'm very confident of it right now.
Likewise.
I guess that'll do it for today. Thank you for joining us. And if you have a question or you think of something in the next, that you didn't think of while we were talking, and I apologize if I missed any, because I've got some kind of banner popped up on the bottom of the computer. And this is still pretty new technology for us as far as doing the webinars. We've done a lot of Zoom chats with people, but not so many webinars. And we're learning. It'll be better next time. We plan on doing more of them. I find that this may be, it won't completely take place of the written word, but we will be sending this out as a recording so that anyone who missed it or wants to see some particular piece of it can go. So all of you and the people not on the call will get a copy of it fairly shortly.
and show it to your friends.
Okay.
Thank you.
Thank you.